Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. Thank you for being here and welcome back to the show. Today, we're going to talk a little bit about capital stacks. We haven't done a show on this in a while, and it's an area that I get a lot of questions about from people who are new to investing in syndications. So in the world of real estate investing, the concept of the capital stack is fundamental because the capital stack represents the total capital invested in a project and the structured layers according to the risk and return profile of each type of financing. Understanding how these layers work together is crucial for investors as it influences their risk exposure, their potential returns, and the overall financial health of the project. So what are the components of the capital stack? Kind of go through these in priority going down. They're really senior debt, mezzanine debt or junior debt, preferred equity, and common equity. So what are each of these things? Senior debt. So this is the priority lender. The senior debt is at the top of the capital stack, being as the highest priority for repayment. If there's a liquidation, typically the senior debt holders are the first to be paid, and they may collect all of the money left and everybody else get left empty-handed if a project goes sideways. We look at the risk and return profile. This type of debt typically carries lower risk because it's secured by the property and it sits at the top of the capital stack. Consequently, it will often have lower returns and especially be returns that are locked in without a lot of upside. Who typically provides senior debt? This is usually banks and institutional lenders providing the senior debt with long-term loans with fixed or floating interest rates. So next in the stack is mezzanine debt or junior debt. Where are they in the priority? This sits below the senior debt, but above equity. So that means they're going to get paid out before the equity partners, but after the senior debt. So this debt is typically considered higher risk because they're subordinated to the senior debt. And to compensate for the increased risk, it usually pays a higher return, typically through a higher interest rate. And sometimes mezzanine debt will have a place where it can be either has equity participation built in or can be converted to equity. Typical providers are specialized middle debt or mezzanine lenders, which can be private equity firms or institutional investors. These are the places that a lot of syndicators in the multifamily world got in trouble. Their senior debt was good, but their mezzanine debt was shorter term, and they didn't get projects completed in time to reissue their mezzanine debt, or they had underwritten the whole thing that when they got rid of their mezzanine debt, they would roll it into their bigger loan at a lower rate than they were able to. So because mezzanine debt typically is shorter, these are usually your construction loan or a remodel loan, but it's one to be aware of how long it is, what are they planning to do with it, and what are the terms, because this is a place that a lot of developers get in trouble. So below debt then becomes equity. Equity is, you typically will have preferred equity or common equity. The preferred equity has priority in that it ranks below debt, but above common equity. It's not debt and does not have a lien on the property, but it does have preference over common equity in receiving returns. Preferred equity holders typically are considered to be lower risk because they receive their returns first. But this also after all the debts have been serviced. They're typically higher than debt, but lower than common equity. Again, sorry, that was a little redundant. Typically, the providers of preferred equity will be REITs or real estate investment trusts, private equity firms, or very high net worth individuals. These are going to be people who make seven-figure plus investments. So then common equity, and for most of the people listening to the show, from my understanding, most of us are falling in this common equity group unless we're investing in a fund or a fund of funds that's putting together enough money from smaller investors that it can buy preferred equity positions. But the common equity is typically at the bottom of the capital stack. They're typically the last to receive distributions and taking on the most risk. But typically, common equity will have the highest potential returns because the investors are compensated for taking the greatest risk. If the project performs well, common equity investors tend to benefit the most. But if it fails, they're the first to lose their money. Typical providers of common equity are typically individual investors, real estate funds, and even developers. When we analyze the capital stack, some of the things we're looking at are the leverage, the amount of leverage, cost of the capital, how the risk is mitigated, and investor objectives. So looking back at these key considerations, leverage. Leverage is the amount of debt versus equity in the project. This impacts the financial structure and the risk profile of the investment. Higher leverage or more debt can amplify returns and give better returns, but also increases the risk of default. And this is just like your mortgage. What it means is if you have higher debt, you're putting less money in the deal, so it's easier to get into the deal. And if it does well, because you put less money in, you see more amplified returns of that amount you put in. But if something changes and it doesn't do as well as you hope, if you have a lot of debt, it can be harder to coverage that mortgage payment because more debt typically has higher payments. But if the amount of debt is only 50%, typically what that means is compared to the amount of money you're bringing in, your debt payments are lower. It's easier to cover the debt payments. But it also means that on the sale or on the back end, when you sell it, because it was less leverage, you're not going to make as much. So this is kind of somebody's own risk reward of what you're looking for as far as how much leverage is in a deal and understanding that risk reward from that perspective. Second, the cost of capital. This is the cost associated with each layer of the capital stack affects the project's profitability. Senior debt is typically the cheapest form of capital while equity is the most expensive. So if somebody's doing a project, and there was somebody on the show recently who was raising capital for a project, and then their senior debt holder came along. When they looked at the project, I don't know, it was like a second, third, or fourth time, because of some changes in the market, they said, wait, we really like this. We will finance the whole thing up front. And so what this did is it changed it for the developer, that it made a super more profitable deal because they didn't have to give up any equity to investors. So it was great for them, but because equity is more expensive, there were no other investors that got a ride along. So that's part of the deal that you get as an investor is you are the expensive cost of capital. And that's because if the project does well, you get the bigger returns. But investors are needed because often there's more capital needed up front. And most developers and syndicators aren't bringing all the capital to the project where that's all that they need is that and senior debt. Risk mitigation. Structure of the capital stack can either increase or help mitigate risk. For example, a developer may use mezzanine debt or preferred equity to reduce the amount of equity they need to invest, thus spreading the risk among more investors. The idea here with mezzanine debt is kind of to bridge, and sometimes called a bridge loan, so that you don't have to put as much out in the whole project, but can get through the beginning of the project typically, which is a build or a remodel. The other thing with preferred equity is that typically those are bigger investors that come in and cover a bigger portion. So all of this structure and how this capital stack is set up all affects the risk of every portion of it. And that's why it's good to know when you're looking at it, are all four of these layers of the capital stack being used? Are there even additional layers? And why or why not have they done it that way? And this really comes down to the investor objectives. Different investors have varying risk appetites and return expectations. Senior debt investors typically are highly focused on capital preservation and consistent returns. Often these are insurance companies, these are retirees. While somebody in the heart of their career who has money coming in, they don't need a return on the investment right away. They're trying to build their net worth, will seek higher returns and may be willing to accept more risk. And especially that's because if you're still working and you have money coming in, one loss isn't going to affect you as much because you're still working and can replace that. So just wanted to go through this again, and in conclusion, you really need to understand the capital stack. And I get a lot of questions about it. This is worth putting some time into and learning about it so that when you're looking at deals, you understand why the capital stack is important and where you stand in the capital stack with your investment. As always, if this is something you have questions about, you'd like to discuss it further, let's set up a call and talk about it. We're here to help. That's why we do the show. You can go to surgeonsyndicate.com, book a call. We can spend 20 minutes talking about this and see if we could help you out a little further. As always, thank you for joining us here on Surgeon Syndicate, and we look forward to seeing you here next time.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.